Okay, thank you. Good morning, everyone. I hope everybody has logged in. I'm just waiting for a minute so that whoever not yet logged in can successfully log in into the session, and then we can start. Whoever has joined in can confirm in the chat box so that I get to know who all have joined by now. Okay, so good morning, Shruti. Good morning, Salish. Good morning, Yedu Kondalu. Good morning, Suresh. Okay, so I think we can start now. So for today, the topic is India's 21, the effects of changes in the foreign exchange rates, right? And we will try to cover this topic in today's and tomorrow's session. Good morning, Abdul. So as the name suggests, the effects of changes in the foreign exchange rates. So what are the effects of changes in the foreign exchange rate that needs to be dealt with by this standard? So, for example, whenever there are any transactions in the foreign currency by any entity, for example, taking of loan in foreign currency from the banks or the financial institutions, or for that matter, any other entity outside India, or making any sales or purchases, imports, exports to other countries. So all those transactions have the effects of changes in foreign exchange rates, right? Now we need to record all these transactions, of course, in our own currency, right? So that's why we need to understand how those transactions will be converted into our own currency for the purpose of accounting and recording in our books of accounts, right? So this standard deals with all such situations wherever there is any effect of changes in foreign exchange rates on any of the transactions, or any of the financial items in our balance sheet and P&L, right? So this is the broad overview of the standard, what it is trying to cover, right? So the objective of the standard is to prescribe guidance. So to provide guidance on inclusion in the financial statements of the entity, foreign currency transactions, and foreign operations. So any transactions which are being done in foreign currency, for example, if I am making a sales in say dollar, I am invoicing in dollar, right? Then my debtor is denominated in dollar as per the transaction. But for the purpose of preparing my books of accounts, recording the journal entry for all such transactions, I need to convert these transactions into INR because I am an Indian company, right? So INR is my domestic currency. So I need to convert this transaction into INR for my accounting purposes, right? And I will reinstate the debtors because debtors is a monetary asset that needs to be reinstated at each reporting date. So for to give effect of any change in the foreign currency rates, right? Because I will be getting the dollars from the debtor. Those dollars needs to be converted into INR, right? So for example, if I'm preparing the financial statements on 31st March, then if there are any outstanding balances of the debtors, all those debtors will be reinstated. Same applies for the creditors. If I have purchased anything from the foreign company, and they have invoiced me in, say, their own currencies, dollars or GBP or euros, then I am liable to discharge that obligation in that currency only, right? For that, I need to go to the bank and buy the, sufficient number of euros, dollars, or GBP, whatever I'm supposed to pay on the date of the due date for the payment, right? So for that, if there are any creditors or liabilities outstanding as on 31st March, then all those creditors or liabilities needs to be reinstated basis on the foreign exchange rate as on that date, right? Closing rate. Another scenario in which, we will be dealing with the foreign currency is foreign operations. Suppose if any company, say USA company, has any permanent establishment in India or any subsidiary JV associate in India. Now that subsidiary JV associate, although established in India, operating in India, but is strictly, doing all the operations as per the guidelines or instructions given by the parent company, which is sitting outside India. So that foreign operation, is operating in a different currency on a day-to-day basis. So if suppose an Indian company has established any foreign operation outside India, then while preparing the consolidated financial statements, I need to consolidate that foreign operation as well in my consolidated balance sheet. Now, foreign operation is maybe preparing the financial statements in that currency, for example, then that foreign operations financials needs to be translated into my own currency for the purpose of consolidation, right? So that is the another scenario where this standard will be giving us the guidance how to, effect this translation of the foreign operations financial statements. Now, third scenario is translation of financial statements into the presentation currency. Now, sometimes it happens, although, we know that all Indian companies prepare the financial statements in INR only, right? That's what we have seen, and that's what we have been doing for ages, right? Now, because IFRSs are the global standards, right? So these standards, are designed from the perspective of the global perspective, right? Now, India has converged to IFRS by coming up with some carve-ins and carve-outs to the respective IFRS series and issued Ind AS, right? So that Ind AS is also talking about the presentation currency. But in India, because all the Indian companies are required to prepare the financial statements in the INR as per the MCA requirement, so we are anyway preparing the financial statements in INR, right? Because that is our legal requirement. But under the standard, we are, having an option to prepare the financial statements into any other currency as well. So that currency will be called the presentation currency. Presentation currency means the currency in which the financial statements are prepared and presented. So suppose if Reliance Industries, apart from preparing the financial statements in INR, because that has to be submitted to the, MCA, if they opt and go for preparing additional set of financial statements, say in US dollars, then how that financial statements will be prepared in US dollars will be guided by this standard. So if I want to prepare the financial statements in any other currency other than my own currency, which will be termed as functional currency in this standard, we will talk about the definitions of all these types of currencies. But for the sake of simplicity at this stage, let's consider domestic currency. So if I am preparing the financial statements in my domestic currency, which is INR, and I want to prepare additional set of financial statements in any other currency, for example, GBP, dollars, or, euros, then how that financial statements will be converted from INR to the other currency, that guidance is given by this standard, right? Now the question comes, why any company will go and prepare additional set of financial statements in any other currency? So there might be any reason. For example, if I want to attract any foreign institutional investors, right? And those foreign institutional investors are asking me to present or convert my 31st March financial statements into say dollars because they understand the dollar better. So instead of, looking at the financials prepared in INR, they want me to prepare the additional set of financial statements, simply converting my 31st March audited financial statements into the dollar and submitting them so that they will analyze that, right, better. They'll understand it better. They can correlate the, size and quantum of the transactions or the balances better because they understand the dollar better, right? So for that purpose, because I need investments from, investors in my company. So if they are asking for this, I have to do this. But for doing this, what is the guidance available? That guidance is given by this standard. Getting my point? So there could be three scenarios. Number one, the transactions which we are doing on a daily basis, like imports, exports, okay, and import of property, plant and equipment, export of property, plant and equipment, taking loans in the foreign currency, giving loans in the foreign currency, right? So all these transactions are to be recorded in accordance with this standard, how the conversion needs to be done for those transactions. Number two, the foreign operation. If any Indian company is having any subsidiary, associate or JV outside country, right? And if that foreign operation, subsidiary, JV, associate is preparing the financial statements in any other currency, then because I need to prepare my consolidated financial statements and I am preparing my financial statements in INR. So I would be needing my foreign operations financial statements as well in INR, so that they are fit for consolidation and I can present my consolidated financial statements. So how the foreign operations, foreign currency financial statements will be converted to INR, that guidance is given by this standard. And the third scenario is, if I want to go ahead and prepare additional set of financial statements, right, in any other currency other than my own domestic currency, then how that conversion of the financial statements needs to be done is guided by this standard. So these are the objective of the standards, so that, we are equipped enough with the sufficient guidance how to do all these translations, right? 1, 2, and 3. Any doubts? Okay. Now, what is the scope? So, as I previously mentioned, scope is the foreign currency transactions. So, any transactions which are incurred in foreign currency are within the scope of this standard, right? So, accounting for the transactions and reporting of the balances from those transactions in the foreign currency. For example, purchase in dollar, right? And debtor, because creditor in dollar, right? Because the other party has invoiced me in the dollar, so I need to convert this purchase transaction into INR for the purpose of my accounting, as well as I need to reinstate the creditor balance at each reporting date basis on the exchange rate on the reporting date. So all these transactions and the balances coming out of those transactions needs to be accounted for and presented in accordance with this standard. Now, what is the exception to this? So there is one exception: derivative transactions and the balances covered by Ind AS 109. So if there are any derivative transactions, for example, futures, options, I have bought for the foreign currency, for the any of the foreign currency futures and options I have bought, and I am doing a trading in those, future and options of the any of the foreign currency contracts, then those are already dealt by Ind AS 109. Hence, they are out of scope of this standard that is specifically given. Now, next is foreign operations. So as I previously mentioned, I need to prepare my consolidated financial statements. Hence, I would be needing the financial statements of my foreign subsidiary or foreign JV or foreign associate duly converted into INR so that they are fit for consolidation. Of course, I cannot consolidate it dollar financial into INR financial, right? So how those financials will be translated from the foreign operations currency to my own domestic currency, right? So that, is within the scope of this standard. And the last is the presentation of financial statements in the foreign currency. Like I previously mentioned, if I want to, present my financial statements over and above my domestic currency into any other foreign currency, then how that conversion or translation will take place, that is guided by this standard. So these are the three broad categories or main items which are dealt by this standard. Any doubts on the scope or objective of the standard so far? And I'm telling you, this is one of the most simplest standard I have ever seen in the Ind AS series. Let me know if it is clear, or if there is any question, just type in the chat box so that I can pick it up right away. Okay. Thanks, Abdul, Namrata, Shruti, and Tariq for the confirmation. Okay. Now there are certain additional scope exclusions which we need to be aware of. Number one, hedge accounting. Now, hedge accounting is, completely dealt by Ind AS 109. In what circumstances hedge accounting can be opted? Furthermore, as you must be knowing that hedge accounting is an optional accounting by Ind AS 109. It is not a mandatory accounting. So either you can go for derivative accounting, or if you want to opt for hedge accounting, then you can opt for hedge accounting, provided you meet certain criteria and conditions prescribed under Ind AS 109. So Ind AS 109 talks about all the, factors of hedge accounting, like when the hedge accounting can be opted for, what are the terms and conditions which needs to be complied with, and during the process of hedge accounting, what are the documentations an entity need to maintain in order to, prove that they are ensuring the compliance hedge accounting requirements and the disclosures, right? So all the parameters around hedge accounting are well, talked by Ind AS 109. So that is completely out of scope of Ind AS 21, right? Presentation of cash flows from transactions in a foreign currency, or to translation of cash flows of a foreign operation in the statement of cash flows. Now we have a very specific standard on the cash flow statement, Ind AS 7, right? So Ind AS 7 is dealing with anything and everything required to prepare the cash flow statement. Hence, we have to strictly comply with Ind AS 7 while preparing the cash flow statement, right? So that is the another exclusion from the scope of this standard. Third, long-term foreign currency items for which an entity has opted for exemptions as per Ind AS 101. Now, I'm not sure if you have already, studied Ind AS 101 by now, or it is yet to be covered in the upcoming sessions. But Ind AS 101 is a one-time standard. That is, it is applicable only once in the lifetime of company, right? So as and when any company, converts or, moves from IGAP to Ind AS, then only for preparing the first set of Ind AS financial statements, Ind AS 101 applies. as the name of the standard is first time adoption, right? First time adoption of Ind AS. So this is applicable only in the transition from IGAP to Ind AS, and thereafter Ind AS 101 has no more applicability. Now, Ind AS 101 talks about certain relaxations which are given in the form of exemptions and exceptions, right? So there are certain exemptions, approx 20 odd exemptions, and 6 to 7 odd exceptions are there, right? So those relaxations in the form of exemptions and exceptions are for a smooth transitioning from IGAP to Ind AS while preparing the first set of Ind AS financial statements. Now, one of the relaxation given in the form of exemption is that if any entity, while preparing their financial statements under old IGAP, right, under AS 11, had opted to apply the accounting for long-term foreign currency monetary items in accordance with para 46 and 46A of that standard AS 11. So that policy can be continued till the time that item exists in the balance sheet, right? So that relaxation is given in Ind AS 101. Now, while doing the first time adoption, if company has availed this benefit given by Ind AS 101, then that Indian GAAP, IGAP accounting policy can be continued in the Ind AS financial statements till the time that item is there in the balance sheet or not de-recognized, right? So only for that item, not for the new items arising on or after the transition date, right? Only for old items. So that accounting policy can be continued. So that is the another scope exclusion. So if that exemption or benefit is availed by any entity while preparing the first set of Ind AS financial statements, so that accounting is out of scope of this Ind AS 21, right? So this is the third exclusion. But this exclusion will not be a permanent exclusion, as it will go away as and when the item gets disappeared from the balance sheet or de-recognized from the balance sheet, right? Now, you will ask, what was that benefit which we are talking about, right? So AS 11 was allowing to capitalize the forex movements on the fixed assets purchased from outside country and being depreciated over the useful life, right? So that policy can be continued for that item till that item is in the balance sheet, right? So these are the three exclusions. Number one, hedge accounting. Number two, presentation of the cash flows from the transactions in the foreign currency. And number three, if old Indian GAAP accounting policy is continued as per the exemption given by Ind AS 101. So instead of, remembering this point like this, just try to, remember this point like old IGAP accounting policy continued as per exemption given by 101. Okay. So if you try to remember this third point like this, you will always, remember it and you will not forget it. So this is the third exemption. So ideally, two scope exclusions are main, and this is because of Ind AS 101, right? Okay. There are few queries. So Kishan is asking, is there any guidance on conversion of INR financial standard for foreign entity for their consolidations? Financial standard or statements? I hope you must be writing a statement only, right? So Ind AS 21 is the converse version of IAS 21. Okay. Now, if the foreign company is, preparing the financial statements under IFRS, then they will be, preparing financial statements under IFRS compliances So they will be applying IAS 21. IAS 21 is, talking the same thing. What's the doubt, Kishan, here? So foreign entity, if wants to consolidate, right, and they have a foreign operation in outside country, and if they are preparing the financial statements under IFRS, then they will apply IAS 21. Similar guidance is there for them. Viraj is saying clear. Namrata is asking, hedge accounting is optional. Correct. Hedge accounting is an optional accounting as per Ind AS 109, right? So whenever the financial instruments chapter you will, cover Ind AS 109 and 32, 107 and 13. So you will get to know about hedge accounting in detail. Tariq is saying, sir, while translation of financial statements in currency other than own currency and AS7 is also followed. Other than one currency. Sorry, I'm not able to get it what exactly you're asking. So whenever we do the translation of the financial statements, then definitely we will be converting all the financial statements, balance sheet, P&L, cash flow statement, and notes to accounts. Full set of the financial statements we will be converting from one currency to another currency. So we will, apply the guidance given in Ind AS 21 for that, for all the statements. And since cash flow statement is being prepared in accordance with Ind AS 7, so that has to be followed for that. Shruti is asking, sir, what are the long-term foreign currency items? Long-term foreign currency items I mentioned now. Suppose if I have purchased a property, plant and equipment, right? And I have capitalized the forex movements on the creditor balance because I have to discharge my obligation as well. So what I am doing as per AS 11, I am capitalizing that into the machinery and getting it depreciated over the long term. So that is called long-term foreign currency items. Any other point? Or should I proceed? Please let me know in the chat box. Okay. Now, till now, we were aware of two types of currencies. One is domestic currency and another is foreign currency, right? So under IGAP, there was no concept of functional currency, right? So IGAP was only talking about one is the domestic currency and other is foreign currency, right? Right? But under Ind AS, there are three types of currencies. One is the functional currency. So under IGAP, this was domestic currency, right? Or INR, basically, for all Indian companies, right? Now, functional currency is the currency of the primary economic environment in which the entity operates. The economic environment in which entity operates. So, Indian company established in India, making purchases of raw material in India, selling the goods in India, collecting the debtors in India, discharging the obligations towards creditors in India, is operating in the Indian economic environment? Yes or no? Yes. So INR would be the functional currency for Indian companies, right? If they are meeting certain criteria. So I cannot say that for all Indian companies, INR would be the functional currency. So there are certain criteria or conditions which we will be studying now, which needs to be fulfilled in order to determine the functional currency. So it is quite possible under Ind AS that for any Indian company, we may come up with a functional currency being dollar, USD, GBP or euro or any other currency for that matter, in spite of the fact company is registered in India. Okay. So under Ind AS, functional currency has to be determined basis on the conditions laid down by the standard. So which all conditions are satisfied, whatever the answer we are able to derive from those criteria, that would be the functional currency, right? So by default, INR is FC. That cannot be said. So INR by default is the functional currency, cannot be said under Ind AS. So we have to determine the functional currency, and if our functional currency is determined as any other currency other than INR, then we have to prepare or present our financial statements in that currency. Although we have the choice of preparing and presenting our financial statements in any other currency as well, which will be called the presentation currency, the currency in which the financial statements are presented over and above the financial statements prepared and presented in functional currency, right? So this is a presentation currency. And what is the foreign currency? Foreign currency is any currency other than functional currency. So if my functional currency is US dollar, all other currencies will be the foreign currencies. If my functional currency is euro, then all other currencies will be the foreign currencies, right? So for example, for Indian company, if functional currency is determined to be say US dollar, then INR would be the foreign currency. Okay. In that case, INR, although it is our domestic currency, but it will be regarded as foreign currency. INR would be foreign currency if any other currency is functional currency. Getting my point? Now, what are those criteria on the basis of which we will be able to determine what currency is our functional currency? Now, just for better understanding, functional currency, as the word functional means the currency in which the functions of the company are being done, right? Or the operations of the company are being carried out. So we can correlate this functional currency to that currency in which company is majorly doing its operations or business activities, right? Now, functional currency will be determined as the currency in which entity primarily generates and expends cash. So the sales are generated in X currency and expenditure are been incurred in X currency, then that X currency will be the functional currency, prima facie. But there are two indicators. Number one, primary indicators. Number two, secondary indicators. Now, primary indicators, category A, subcategory 1. Currency that mainly influences sale price of the goods and services. Now, keyword here is influences sale price. Influences sales price. Okay. So this is the keyword here. So always focus on keywords, because if we miss keyword interpretations, then we will end up mistaking in our conclusions. So keyword here is the sales price are influenced by which currency? That currency is the functional currency as per primary indicator A category subcategory 1. Okay. So that is the first condition. Another condition, subcategory 2, currency of the country whose competitive forces and regulations mainly determine the sale price. So keyword here is determine the sale price, right? The country whose competitive forces means competitors. The country whose competitors, that is competitors means the same company, the companies who are, selling the same products or services as I am selling. Now, if they are selling cheap, I have to bring down my prices, right? So their competitive forces are, influencing or determining my sales price, right? Because I am forced to follow the sale prices they are, quoting for the similar products and services in the market. Otherwise, I will be missing on the sales, right? So I have to be competitive. So in order to be competitive, I will adjust my selling price according to the competitive forces, right? And the regulations. Suppose if there are any government rules, laws, bylaws, notifications, regulations, which I need to follow in order to determine the selling price for my goods and services, then those regulations are given by, suppose, America, then USD would be the functional currency as per this condition, right? Clear? Category B, currency that mainly influences labor cost, material cost, and other cost of providing goods or services. So all my direct and indirect costs are being incurred in a particular currency. Then as per category B, that currency could be your functional currency, right? So indicator number 1, selling price is influenced, right? Condition number 2, selling price is determined by competition or by regulations. Third condition, direct and indirect costs are incurred in which currency, right? That I need to look at, right? So this is the third condition. Now, secondary indicators. So these are called the primary indicators. They needs to be checked first. If we are not able to conclude on the functional currency basis on these primary indicators, then we have to move to the secondary indicators. Now, what are those? Currency in which funds from financing activities, for example, issue of share capital or equity instruments, issue of debts or bonds are generated. So I am generating funds for operating, for my operations or for conducting my business, either by issuing debt or by issuing equity or by issuing both. In which currency? So if I issue equity share capital, say in dollars, or I issue bonds in dollars, then dollar would be the functional currency as per this condition, right? And second is currency in which receipts from operating activities are usually retained. So once I am done with the manufacturing, once I have sold those goods, whatever I had manufactured, and now I am collecting my debtors. And after collection, in which currency I retain cash? So this is called retaining cash in which currency? Okay. So this is the currency would be the functional currency, because it indicates that, boss, if you are retaining cash in a particular currency, it indicates that you are, doing the things in that currency, or you are dependent for your future activities in that currency. That's why you are retaining cash in that particular currency, right? Now in India, if I retain cash in dollar, then it may indicate that my major expenditure would be incurred in the dollar. Hence, I am, retaining in whatever the profits are or collections are there, I am retaining that in the dollar, right? If I am retaining in euros, then it indicates I may be, forcing any expenditure in future, major expenditure in euros. So this indicates that this is the currency, maybe the functional currency. Now, none of these 1, 2, 3, 4, 5, none of these 5 conditions, are to be interchangeably, applied. So we have to apply all these 5 collectively to any situation basis on the facts and circumstances and information available, right? Now, in practical life, we have to apply all the 5 together, right? 1, 2, 3, 4, 5. Because in practical life, we can ask management for their responses on all these 5. Yes or no? Yes. Whatever data information we need, we can ask and we will get it. And basis on that, collectively applying all these 5 conditions, we will be able to derive the conclusion. But in examination, whatever the facts and circumstances are available in the question, basis on that, which condition, can be applied, we can apply only that condition, right? In that case, we will not assume any other condition by default, right? So whatever the facts and circumstances are there in the question, limited to those facts, we have to select and apply the appropriate or right condition and come up with the conclusion for examinations. In practical life, of course, we have the advantage of getting answers to all the 5 conditions from the management. Getting my point? Okay. Now there are few questions. Shruti is saying functional currency in which entity operates, meaning if a company is operating in London, so functional currency will be euros. So that is a general layman approach, right, Shruti? So I agree with your point completely. So if company is doing all of its business in London, then certainly, but how come euros? London has which currency? It is GBP, right? Great Britain pound. So GBP would be the functional currency by default, but we will not jump on to the conclusions just because the location of the company in which it is operating or doing the business. So again, as I have previously said in other standards as well, we don't need to come up to the conclusions basis on our general understanding or layman approach or intuitions, right? We have to stick to these rules or the guidance given by the standard. And once we tick on that, we will be, deriving the right conclusions. Okay. Question is asking what is the difference in the what is the difference in foreign and FS presented currency? So foreign currency is the currency other than the functional currency, right? Now his question is, what is the difference between foreign currency and presentation currency basically, right? So if suppose dollar is my functional currency, right? It is determined basis on the rules. Then all other currencies, by virtue of dollar being functional currency, will be the functional foreign currencies, right? So in that case, INR is also the foreign currency, right? Getting my point? Now, if I want to prepare the financial statement, say in GBP, okay, then although GBP is my foreign currency, but GBP will also be my presentation currency. So anyway, whenever you present the financial statements in any currency other than the functional currency, that currency will be regarded as presentation currency, but that will not, give away the color of foreign currency to that currency. So that currency will still be the foreign currency, but one of the foreign currency, of course, will become your presentation currency. So presentation currency is that foreign currency in which the financials are prepared. Clear, Kishan? I have answered your query. So Namrata is saying in point, both conditions need to fulfill. Right. So we have to collectively look at primary indicators, 3 conditions, and secondary indicators, 2 conditions, all in all 5 conditions. These 5 conditions we have to be very clear on. And basis on the facts given in the question, we have to, apply the appropriate condition, being applicable on those facts and circumstances. Viraj is asking, if software companies earning revenue 100% from US, for example, Infosys, TCS, they, export majorly in the US, right? And UK and other countries, then this Ind AS applies. Okay. So Ind AS 21 applies to all the foreign currency transactions. Now, for example, Infosys, TCS, Tech Mahindra, HCL, all these companies, are heavily, dependent on their revenues from the US and UK and other, Middle East countries, right? Now, majorly they are exporting their software services to outside country, 70-80% revenue, or even if you have, assumed it 100%, let's assume 100%. 100% revenue is coming from outside India. Okay. Now the question is, does this standard apply? So this standard will anyway apply. Infosys is an Indian company. Yes or no? Yes. Infosys is doing, all the sales to outside country. Does that mean that Infosys is not required to prepare the Ind AS financial statements? No. Infosys is still required to prepare the Ind AS financial statements. Now, if I need to prepare Ind AS financial statements, I need to comply with all the Ind ASs. One of the Ind AS is Ind AS 21. Hence, I need to comply with Ind AS 21 as well. Now, what sort of compliance I need to do? For all my export transactions, that is export of software services, I need to record those transactions by converting into INR. If INR is determined to be my functional currency, if Infosys comes up with the assessment that INR is not the functional currency, say US dollar is the functional currency because they are, doing all the exports and they are, basis on these 5 parameters, they are not, the functional currency is determined to be US dollar, for example. In that case, what will happen? Infosys will be required to prepare Ind AS financial statements? Yes. Will it be required to submit its financial statements in INR to MCA? Yes. So for preparing that, again, Ind AS 21 will apply. So application of the standard is not to be decided whether the company is exporting or importing 100% of its products or services from outside India or not. So that is the transaction. Standard is anyway applicable. Okay. Abdul is asking, do these conditions should satisfy or condition and condition? Okay. Your question is good. Now, Abdul is asking whether all these 5 conditions needs to be satisfied or any of these 5 conditions can be satisfied. So any of these 5 conditions can give you an answer. Which currency would be the functional currency? So these are not all the conditions needs to be satisfied, right? As I mentioned, we basis on the facts and circumstances, I need to decide which condition is, more appropriately correlating with the facts. So that condition I will be applying and checking and coming up with the conclusion. So this is not or, or this is not and, this is or. So any of these conditions can, give you the correct answer. But if you are not getting the answer, say first you applied, say first condition, you are not getting the answer. Then you applied second, you are not getting the answer. For third, the facts and circumstances are not available in the question. Then you can anyway not able to apply this. Then you come up to the secondary indicators. Then you are not getting the answer because there are no such financing transactions happened, right? So you are not getting any answer. Then you will see this one. So basis on these three conditions, you will be able to conclude. So any one, any two, any three, any four, or all five, right? Conditions can be applied. Correct, Abdul? Tariq is asking primary indicators based on the customer requirement, perfect competition market. Sorry, what is your question? Namrata is asking if primary indicators telling INR is the functional currency, but secondary indicators indicates USD is the functional currency, then primary indicators have more weightage over the secondary indicators. If primary indicators suggest a particular currency is the functional currency and secondary indicators suggest otherwise, then primary indicators have to be given weightage, and the answer coming up from the primary indicators has to be finalized. That's why they are called primary. Otherwise, the standard wouldn't have said primary or secondary. A standard simply laid down 5 conditions. So a standard has demarcated these set of 5 conditions into 2 categories. First is the primary, second is the secondary. So secondary comes only if primary is not giving the answer. Good question, Shruti. These 5 conditions. So Shruti is asking, these 5 conditions have or and and between them. I mean all. So I have already answered this, right? So we have to collectively apply all the 5 conditions, but it is not that all the 5 conditions has a, and conjunction. So any of the 5 conditions, any set of 2 or 3 or 4 conditions out of the 5 conditions can be applied. Kishan is saying now it is clear. Okay. Tariq is saying both primary. Yes. So you are saying that influence of the sales price and determination of the sale price, both are primary conditions. Yes, that's correct. Namrata is saying it means every presentation currency is foreign currency, but every foreign currency is not presentation currency. Perfect. So every presentation currency has to be a foreign currency, right? Because presentation currency is one of the foreign currency, but all the foreign currencies cannot be presentation currency because we are not preparing financial statements in all the foreign currencies. Suppose if I present my financial statement, say apart from INR being my functional currency in US dollar and GBP, then US dollar as well as GBP will be my presentation currencies, but all other currencies except these two will not be regarded as presentation currency. So presentation currency is that foreign currency in which additional set of financial statements are being prepared. Namrata is saying INR will be the presentation currency for Infosys. So I am not saying for Infosys TCS INR is the functional currency or presentation currency. That has to be determined based on these factors. Although I know certainly that for Infosys and TCS, INR is the functional currency, but still we have to check on these conditions, right? We cannot conclude without applying the conditions. So Viraj is saying, thank you for clearing the concept. Shruti is saying functional currency can be same as presentation currency. Of course, if I do not intend to prepare additional set of financial statements in any other currency, and I continue to prepare only one set of financial statements in my functional currency, then functional currency is only presentation currency. So presentation currency is the currency in which financial statements are presented. As the name suggests, presentation. In what currency I am presenting? So if I'm not presenting in my financial statements over and above the functional currency, then functional currency is only presentation currency in that case. Shruti is saying, okay, this is done. Mohammed is saying clear. Namrata is saying in point A, both conditions 1 and 2 need to fulfill simultaneously. No, as I mentioned, we have to apply all these conditions based on the facts and circumstances available. So if I have the facts available for both these conditions, I will be applying both. If I have the facts available only pertaining to A subcategory 1, then I will be applying A subcategory 1 condition only. So this is not and, this is or. So these 5 conditions are not to be complied, all together. These 5 conditions are collective, not, joint conditions. So either of these 5 conditions or any combination of these 5 conditions can be applied. Okay. Viraj is asking, sir, if pharma companies are exporting less than 50% of its products, then is this Ind AS applies? So Viraj, I think you are fundamentally diverted from the scope of the standard and determination of the functional currency. So scope of the standard is anyway there. Standard will anyway apply because if I am required to prepare my financial statements under Ind AS, Ind AS 21 by default applies because my financial statements have to be complied with all the Ind ASs. Applicability of Ind AS is not dependent on the revenues or the business operations of the company. So if I am preparing financial statements under Ind AS will apply. Chapter closed. No other conditions. I need to check. Shruti is asking, thank you for clarifying the doubts. Okay. Tariq is saying now it is clear. So now only question left is for Viraj. Are you clear with the scoping? You are asking whether standard will apply. Standard will anyway apply to all those companies who are required to prepare the financial statements under Ind AS. We are not discussing here that if company is generating revenue from Americas or London, whether the Ind AS will apply. So that is not the question of, right? Question is whether the functional currency will be the dollar, GBP or INR. That is the question. Clear, Viraj? Or still you are confused? Let me know. Okay, thanks. Okay, I think I have taken everybody's query. If I missed any or if there is any additional thing anybody wants to ask, please clear it right away because this is the fundamental concept of this standard. If we are not clear on this fundamental, then it will be difficult to, apply the standard. Okay, thanks. Now we are equipped enough with all the 5 conditions which we will be applying to determine the functional currency. Here is the question. Future Limited sells revitalizing energy drink that is sold throughout the world. Sales of the energy drink comprises of 90% of revenues of the Future Limited. So 90% sales are coming by selling this energy drink. And this energy drink is being sold throughout the world. For convenience and consistency in pricing, sales of the energy drink are denominated in US dollar. All financing activities of Future Limited are in its local currency, although the company holds some US dollar cash reserves. almost all the costs incurred by the future limited are denominated in local currency. So local currency, for example, we can assume INR. Okay. So local currency is INR, we can assume. Now, what is the functional currency of the future limited? Now, first of all, basis on the facts and circumstances given in the question, we need to identify out of the 5 conditions, 3 primary, 2 secondary, which all are getting activated here to be applied. So first identify, then tick on whether the condition is complied, yes or no. Complied, okay, what is the answer? Not complied, leave it. Then complied, what is the answer? Now, you give me the answer in the chat box. USD is the functional currency or local currency? That is INR is the functional currency. Just write USD, INR, USD, INR. I'll get to know. So Tariq is saying F functional currency is USD. Okay. Others? Kishan Kumar is saying INR local currency is the functional currency. Okay. Mufitha is saying US dollar is the functional currency. Okay. Viraj, Shruti, Namrata, Abdul. Where are your answers? Namrata is saying local currency as mainly influences labor, material, and other costs of providing goods or services. Hence, I will give or cast my vote in favor of local currency. Okay. Shruti is saying INR is the functional currency, and Yedu Kundalu is saying local currency is the INR. So more inclination is towards INR. Nobody is liking US dollar, in spite of the fact US dollar is very costly. Okay. Local currency is the currency of the country whose competitive forces and regulations mainly determine the sales price of its goods and services. Further, significant portion of the costs are in the local currency and sales are denominated in USD currency only for the purpose of convenience and consistency in pricing. Financing activity is also done in local currency. This can further support the conclusion that the functional currency is the local currency and not USD. Now, who all have answered in favor of local currency? If have answered after applying all these, underlying criterias, then it is fine. If you have missed on any of the condition, then you should check which condition you have missed. Although your answer is correct, but which condition you did not apply. That needs to be, kept in mind. Now the people who have answered US dollar may have missed on the keyword which I had encircled right before I started talking about these conditions. And that keyword, in fact, I have written here, keyword is the influence sales price, influencing sale price, right? Now, in the facts of the question, it is not said that US sales price of the energy drinks are influenced by US dollar. It is saying denominated in US dollar for convenience and consistency. It is not influenced. It is denominated for convenience and consistency. Right? Now, what is the difference between influencing, getting influence or not getting influence? If I'm denominating in USD, what does that mean? So if I'm denominating the price in USD, it does not mean that you have determined the selling price in USD. So what could have been done in this case? Suppose, sorry, it might be possible that I might have incurred raw material cost, say rupees 100 rupees per unit. Okay. Direct labor cost, I might have incurred 50 rupees per unit. Other cost, I might have allocated 25 rupees per unit. Now, 175 might have been my cost, which has been determined in INR, right? Here, the question talks about this, that all the costs are incurred in the local currency. Now, I might have added a markup of, say, 20% to this. Okay. So, 35 rupees, I might have added the markup. 0, 0, and 2. Sorry, 210, right? So 210, I might have determined the selling price. Now, because I'm exporting majorly in various countries, and those various countries understands dollar better than INR. So what I have done, I have converted my selling price and denominated in dollar. Say dollar is, say, suppose 80 rupees. Uh, so I have converted it into by dividing 80. So there might be $2, for example, just for the sake of simplicity. $2. Okay. So $2 is the denomination in of selling price, not influence. So I have just denominated my selling price for the sake of convenience and consistency across the globe, right? So it is not the fact that my selling price is influenced by the dollar currency, right? So that is the difference which we need to understand. So condition A is saying selling price is influenced, right? So that is the keyword which we have missed here. Okay, clear? Next question. Small India Private Limited, that is small, a subsidiary of Big INC, takes orders from Indian customers of the Big INC's merchandise and then bills and collects for the sale of the merchandise in rupees. Small also has local warehouse in India to facilitate timely delivery and ensures that it remits to its parent all the cash flows it generates, as the operations of the small are primarily financed by the Big INC. Big INC is based out of the US, and Big INC's functional currency is the US dollar. What is the functional currency of the small? Read the question carefully. Identify which all conditions are getting applied here. Apply them, come up with the conclusion, and tell me in the chat box. Any luck with the answers? Viraj is saying INR is the functional currency as sales are in INR. Okay. Others? Kishan Kumar saying USD is the functional currency as the pricing is influenced by the parent. Okay. Shailesh is saying USD is the functional currency. Okay. Try to be responsive in the chat box. Others? Abdul is saying USD is the functional currency. Okay. So three people have said so far USD and one is in the favor of INR. Others are still finding out. Okay. Let's see. Small, although based in India, with its cash flow generated in India, is essentially a pass-through company established by its parent. Small is totally reliant on the big INC for financing and the goods to be sold, despite the fact that goods are sold within India and sales are made in INR. Therefore, small is not a self-contained entity in India, rather an entity that is dependent on its parent. Due to this dependency of the small on its parent, it can be said that the primary economic environment for small is that of the US, and thus the functional currency should be also be the USD. Hence, all the transactions of the small which are denominated in the currency other than the USD should be recorded in USD at the spot rate, and any changes in the exchange rate would result in an exchange gain or loss to be taken to the statement of the P&L. Now, let's go back to our rule book. Functional currency will be determined as the currency in which entity primarily generates and expends cash, right? And then primary indicators were sales price is influenced by a particular currency. That currency could be the functional currency, right? Sale price is determined by the competitive forces and regulations of a particular country. Then that country's domestic currency would be the functional currency, right? And the third currency that influences the cost, right? That currency could be the functional currency. Then secondary indicators were financing is done in a particular currency. That currency would be could be the functional currency, and the cash retained finally. Now, basis on the facts, which conditions we can apply? Now, small takes orders from Indian customers. So it is taking orders from the Indian customers, then getting the goods from the parent company sitting in the US dollar. So who is doing the manufacturing activity? US company is doing the manufacturing activity. Who is deciding the sale price of those goods or merchandise to be sold in India? US company is deciding the selling price. And then because the sales are being made in India, so that selling price might have been converted into INR for the purpose of, selling those goods in India. But in whose currency selling price is determined? That is USD, right? So which condition is being fulfilled here? Condition number 2, A2, the currency of the country whose competitive forces and regulations may determine the sale price. So sale price is being determined by US company, right? Now, small has a warehouse only where they can store the goods received from the parent and ensures the timely delivery. And as the sales are realized from the debtors, they remits all of its cash to the parent. That is, they convert the cash back from INR to USD for remitting to the parent company. It means they retain cash in USD only, because as soon as they collect the cash, they convert it into USD and remit it. And now they are financed by big INC. So for all its operational expenses, day-to-day expenses, they are dependent on the US company. So this is nothing but an extension of the US company. So US company has extended its arm in India, and selling price is being determined by them. Financing is being determined by them, right? This company is acting as an agent only here, and they are completely operating in the environment of the US, right? Because they are guided by their parent company for anything and everything. So it can be said that they are not doing anything independently. They are just an extension of the US company. Hence, US dollar is the functional currency. Clear? Okay. Now, there are 4 more conditions. Number 1, number 2, number 3, and number 4, which will determine the functional currency of the foreign operations. Determination of the functional currency of the foreign operation, additional factors. So now don't get confused. So this is the determination of the functional currency. Determination of the functional currency for any company, any entity, right? And there are 2 categories, primary and secondary. Primary has 3, secondary has 2. So all in all 5. So these are 5 criteria which needs to be fulfilled for determination of the functional currency for any of the company or entity. Now there are 4 additional conditions which we will be talking about, which are to be checked only for determination of the functional currency of foreign operation. So if any Indian company has any foreign subsidiary, then that foreign subsidiary's functional currency needs to be determined in accordance with these 4 rules. Now, functional currency will be the same as of the reporting entity. Reporting entity means the parent entity. Right? Reporting entity means parent entity. Right? Now, functional currency will be same as that of the parent entity. Suppose if parent entity's functional currency is INR, then it will be same of the foreign subsidiary which I have set up in Japan if these 4 conditions are satisfied. Now, what is the first condition? When activities of the foreign operation are carried out as an extension of the reporting entity. This condition, I think we have just seen in our previous example itself. Here, big INC was the parent company, right? Parent company, and small was the foreign operation. Now, small was just an extension of the big INC, right? So this is the first condition. When activities of the foreign operation are carried out as an extension of the reporting entity. So if this condition is met, we can say, because it is just an extension and that foreign operation is doing anything and everything as instructed by the parent company, and is operating in the environment the parent company is operating. Hence, parent entity's functional currency would be the functional currency of the foreign operation as well. Clear? First condition. Second condition, when transactions with the reporting entity, that is parent entity, are in high proportion of the foreign operations activities. Suppose foreign operations is making 100 crore sale. Foreign operation is making a 100 crore sale during the year, and 90 crore is to the parent entity. Or if foreign operation is dependent for major or significant activities or proportion of any transactions with its parent only, then it can be said that they are highly dependent on the parent company. So they are governed by the parent company in its entirety. Hence, this functional currency of the parent company will be the functional currency of the foreign operation, right? Third condition, whether cash flows from the activities of the foreign operation directly affect the cash flows of the reporting entity and are readily available for remittance. So as soon as the sales are made by the foreign operation, cash is collected from the debtors. It is quickly converted into the currency of the parent entity and remitted to the parent, right? So if that is happening, right, it means this foreign operation is doing nothing on its own. It is simply acting as an agent, sales and collection agent, right? Fourth, when cash flows from the activities of the foreign operation are sufficient to service existing and normally expected debt obligations without funds being made available by the reporting entity. So in this case, what will happen? Foreign operation is dependent on the funds from the foreign parent. So in that case, the functional currency will be the same. And functional currency will be the different if foreign operation is operating with its significant degree of autonomy. That is, it is doing the business the way it wants to do. It has all the decision making with them, right? So they are operating independently from the parent. In that case, functional currency could be a different currency from that of the parent, because here the company is operating on its own independently, right? When transactions are in low proportion, so they are making sales to other parties as well, and they are not dependent for its sales or purchase on the parent company. When they do not remit the cash to the parent company, right, immediately, and when they can do their financing activities themselves and they are not dependent on the parent company. Let's do this question. Holding company H Limited has a business of supplying raw iron ore to the major steel makers abroad. So this is the holding company, right? And it is into the business of supplying iron ore to steel makers in abroad. For this purpose, it engages its subsidiary S Limited in Japan. S Limited, which takes orders from the Japanese customers and receives goods from the holding. It also collects proceeds, which is always in Japanese yen, and remits it to the parent company. Whole of the funding of the subsidiary is being managed by the parent company, including administration and other expenses. There is no other role of the S Limited being played. Determine the functional currency of determine whether the functional currency of H Limited INR can also be considered as the functional currency of its subsidiary set up in the Japan. So tell me, functional currency of subsidiary in Japan is INR or the Japanese yen? So Namrata is saying INR. Abdul is saying INR. Yes, for INR. Namrata is also saying same. Others? INR is the functional currency of the subsidiary S. Viraj is saying. Tariq is saying S Limited is acting as an agent of S Limited. Hence, functional currency of S Limited is INR. Shailesh is saying INR. Shruti is saying INR. Christian is also saying INR because functions and operations of S Limited are controlled by H Limited. Okay. Yedu Kondulu is saying INR and Muftika is also saying INR. So unanimous answer given by everybody is INR. Let's see. Since the operations of S Limited is simply an extension of the operation of H Limited, S Limited does not have a significant degree of autonomy. So while answering in the examination, always try to use these conditions as a basis of your conclusions. So use the word significant degree of autonomy, low proportion of the transactions, does not readily remit the cash. So try to use these words as a basis of your conclusion in the answer in the examination, right? Hence, currency Japanese yen cannot be considered as functional currency of S Limited. For this purpose, currency of the parent company, that is INR, will be considered as the functional currency of the subsidiary. Correct? Let's try this one. So we have to master all these 3 plus 2 set of 5 conditions and 4 additional conditions for foreign operations. So all in all, 9 conditions. All these 9 conditions we have to, remember and master its application. A is an Oman based company, Oman, right? Having a foreign operation. B in India. The foreign operation was primarily set up to execute a construction project in India. The functional currency of A is OMR. So A is the parent company. B is the subsidiary company. It is in Oman, right? And its currency is OMR. Okay. And S is in India, right? And its functional currency needs to be determined. 78% of entities B finances have been raised in USD by way of contribution from A. So 78% of the financing activity is, done in USD by way of contribution from A. So A has purchased the equity, right? So they have 78% stake in A. Okay. Oh, sorry, in B. B's bank accounts are maintained in USD as well as INR. So B has bank accounts maintained in USD as well as in INR. Cash flows generated by B are transferred to A on a monthly basis in USD in respect of the repayment of the financing received from A. Okay. So this might not be the equity financing. This might be debt financing, right? So they are doing a repayment on a monthly basis. Revenues from B are in USD. Its competitors are globally based. Tendering for the construction project happened in USD. So when they have applied for the construction project, the tendering or bidding was done in USD. B incurs 70% of the cost in INR and remaining 30% cost in USD. So whatever the costs are being incurred in execution of this construction, 70% costs are in INR and 30% costs are in USD. Now, since B is located in India, can it presume its functional currency to be INR? So tell me, what is the functional currency, INR or OMR? So set of 9 conditions all in all we have. 3 primary, 2 secondary, 4 additional for the foreign operations. Tariq is saying OMR is the functional currency. Okay. Abdul is saying INR is the functional currency. Viraj is saying OMR is the functional currency. Okay. Where are others? Kishan is saying functional currency will be the OMR as the B Limited is getting monthly finances by A and most of its revenues get transferred to the parent. Okay. Namrata is also of the view of OMR is the functional currency. Let's see. No, we cannot assume or presume INR to be its functional currency on the basis of its location. So, of course, at least we cannot presume any currency to be its functional currency just because the location they are operating. So that's right. That is well understood. Now we will determine. It needs to consider the various factors listed in the Ind AS for determination of the functional currency. So by virtue of location, we cannot come to the conclusion that because this company is in India, INR is the functional currency, this company is in USD, so USD is the functional currency. Had that be the case, then why was the need to design so many conditions and criteria which we are studying, right? Primary and secondary indicators should be used for the determination of the functional currency of B, giving priority to primary indicators. Now, priority is always to be given to the primary indicators. The analysis is as follows. Number 1, its significant revenue and competitive forces are in USD. Its significant portion of cost is incurred in INR, that is 30% costs are incurred in USD. 78% of the finances have been raised in the USD. It retains its operating cash flow partially in USD and partially in INR. Keeping these factors in view, USD should be considered as the functional currency of the B. क्या हुआ हमसे? Where we were wrong. We were struggling with the INR and OMR, but answer comes out to be the USD as the functional currency, right? Now, what went wrong? See, we will see the question again. A is the Oman-based company, right? Having its operations in B in India. So B is the subsidiary or, foreign operation for A in India. So by virtue of location, INR cannot be the functional currency. That is clear. Now, A's functional currency is OMR anyway. Now, 78% of the B's finances have been raised in USD. So financing is taking place in USD, right? Although the contribution has been done by A and A's functional currency is OMR, right? But financing is being done in USD, right? And if I go back to my condition slide here, what was the condition? Sorry. Currency in which the receipts from the operating activities are usually retained and currency in which the funds from the financing activities are generated. So currency in which the funds are generated. right? Not the currency of the company from whom the funds are raised, currency in which the funds are generated. So what is that currency here? That currency here is US dollar, right? Now, these bank accounts are maintained in USD as well as in INR, and on a monthly basis, monthly repayments of the financing activities is also being done in USD. So funds are generated in USD, funds are repaid in USD. Revenues are also in USD, and tendering, that is the contract construction project for which the tendering was done, that was also done in USD, right? So it means selling price is determined in USD. 70% cost is incurred in INR, 30% cost is incurred in USD. Now, keeping all these factors in mind, what is the conclusion? Conclusion is significant revenues is in USD. Yes or no? Yes. Significant portion of the cost is incurred in INR. So this condition is not meeting. This condition is meeting in the favor of USD. 78% of the finances are raised in USD. This condition is also meeting. It retains its operating cash flow partially in USD and partially in INR, right? So again, 50-50. Suppose, for example, we do not know the proportion, right? So basis on this collective assessment of all these conditions, which condition is to be given priority? Priority is to be given to the primary indicators. Primary indicators is sales price. Sales price or the revenue is determined in USD. So that is the primary indicator. So primary indicator will, bypass secondary indicators, right? So here is the primary indicator. Basis on that, USD would be the functional currency. I think only Yedu Kondalu has given the answer in favor of USD. So this was the catch in this question. So we need to strictly apply the conditions. Do not assume anything, consciously or subconsciously even. Just simply come up and apply the condition and see what is the answer. Doing that only you will get to know the correct answer. Clear? Any doubts? Please confirm in the chat box. It is now clear after discussing the answer, or still there is any doubt or any condition which you think, still needs to be checked and giving us a answer otherwise. Abdul is saying clear. Viraj, Shruti, Muftaga, everybody is saying clear. Perfect. So what we will do, we will not stick to our, general understanding or intuition. We will simply follow the checklist. We will tick up each condition. What is the answer? We will write, because in this case, what we have noticed, different conditions are giving different answers, right? Then once we come up with all the answers basis on different conditions, say one condition is saying USD, other is saying OMR, third is saying INR, fourth is saying USD. Then we will see which conditions are the coming from the primary indicators. Those needs to be prioritized over the secondary indicators. If primary indicators conditions are giving the answer, say USD, then USD is the answer. If primary indicators conditions are giving the answer as OMR, then OMR will be the answer. Okay. So secondary conditions will come into play only if primary conditions are not giving any answer, right? Kishan Kumar is saying, so B Limited will also have to do financials in INR for ROC filing. See, any company established in India, registered in India, is anyway required to submit the financial statements to ROC. And that have to be done in INR only, right? So that is a legal requirement. So we are not going to, confuse ourselves with that requirement. Basis on this standard, we need to identify whether our functional currency is INR or not. If INR is the functional currency, easy. If INR is not the functional currency for an Indian company and any other currency emerges out to be the functional currency, then that currency will be used as functional currency for preparing the financial statements by default. And other currency in which the financial statements are being prepared will be the presentation currency. Clear, Kishan? Okay. So I generally, give the break when one concept is over and another is to be started, but we are still in midway. So I think we should try this question first. And because I know for certainty that thereafter we will discuss this next concept or next, topic. So we will have a break after this question, right? Hope that is fine. The quicker you will be in responding, sooner you will get the break. S Limited is a company based out of India, which got listed on the Bombay Stock Exchange in the financial year ended 31st March 2001. Since then, the company's operations have increased considerably. The company was engaged in the business of trading of motorcycles. The company only deals in imported motorcycles. So पहली बात तो ये है, S Limited is listed on BSE, right? And is an Indian company dealing in imported motorcycle. Okay. These motorcycles are imported from US. So these are the facts. After importing the motorcycles, these are sold across India through its various distribution channels. The company had only private customers earlier, but the company also started corporate tie-ups and increased its customer base to corporates also. The purchase of the motorcycles are in USD. So purchases from the US company are being done in USD purchases. Because the vendors from whom these motorcycles are purchased, those are all located in US, right? So they are billing in USD. All other operating expenses of the company are incurred in India only because of its location, and they generally happen to be in INR. So apart from purchases, other expenses are in INR, right? Currently, the customers are both corporate and the private in the ratio of 70 to 30 approximately. The USD denominated prices of motorcycles in India are different from those in other countries. The company is also expecting that in the coming years, its customer base will increase significantly in India and the current proportion may also change. Currently, the invoices are raised to the corporate customers in USD. So sales are being made in US dollars for the purpose of hedging. However, private customers don't accept the same arrangement. Hence, invoices are raised in INR. So for private customers, invoices are in INR. And for corporate customers, invoices are in USD, right? For the purpose of hedging. What would be the functional currency of this company? हाँ जी. So कहानी लंबी है क्वेश्चन में, but I have, highlighted key points or key facts for your benefit. Namrata is saying INR as the sales price for Indian customers are different from the other. So you are saying INR is the functional currency. Okay. Others? Kishan is saying functional currency is INR as as it is an independent company for its operations and not dependent other than import on others. Sales is happening in India majorly in INR. Okay. Viraj is saying USD is the functional currency as it only deals in imported motorcycles. Okay. Tariq is saying, or as all the purchase import are in dollar, so dollar is the functional currency. Abdul is saying since the company is following hedging by way of accounting, it is out of scope of Ind AS 21 and the private customers, they are just raising invoices in INR. Okay. But currency INR. Okay. You are saying INR is the functional currency. Yedu Kondulu is saying INR. Manoj is saying INR. And okay. Ind AS 21 gives greater emphasis to the currency of the economy that determines the pricing or selling price of the goods, right? As opposed to the currency in which the transactions are denominated. So determination of selling price is crucial rather than denomination. Okay. So denomination can be in any currency. We have to focus on which currency is determining the selling price. Sale prices for motorcycles are mainly influenced by the competitive forces and regulations in India. The market for motorcycle depends on the economic situation in the India, and the company is in competition with importers of other motorcycle brands. Even though 70% of the revenue of the company is denominated in USD, Indian economic conditions are the main factors affecting the prices. This is evidenced by the fact that USD denominated sales price in India are different from USD denominated sale prices for the same motorcycles in other countries. Management is able to determine the functional currency because the revenue is clearly influenced by the Indian economic environment and expenses are mixed because purchases are happening in USD and other expenses are happening in INR. On the basis of above analysis, INR should be considered as the functional currency of the company. Now, key point here is sales price determination in which currency. So sales price determination is happening in INR because the prices are although denominated in dollar for the purpose of hedging or any sort of convenience, they are different from other global countries selling price in the dollar as well. So they are getting impacted by the Indian economic environment, that is demand and supply, by the Indian customers, right? If there is a demand, I will increase the price. If there is a low demand, I have to, sell the goods at lower price. So that role of demand and supply in India in economic environment for these imported bikes is affecting the selling price. That selling price, although is converted or denominated in dollar, doesn't mean that selling price is determined in the dollar, right? Hence, INR is the functional currency. So I think answer everybody has given INR. But I hope you have given the INR as answer basis on this condition rather than any other conditions which are not, applicable here. If any doubts, let me know in the chat box. Else, I can start the break right away. It's 8:50. We will resume at 9. 10 minutes break starts now. Please confirm in the chat box so that we can resume the session. Should we start? Okay, Viraj has confirmed in the chat box. Okay. Choice and change of the functional currency. Choice. Do we have choice to decide the functional currency? No free choice. अगर choice होती तो why we would have been studying so many conditions for last couple of hours, correct? So there is no choice. Functional currency has to be determined as per this standard. Correct? An entity cannot change functional currency unless the facts and circumstances relevant to its determination change. So, once we have determined the functional currency, we cannot change the functional currency unless the facts and circumstances basis on which that determination has taken place has changed. So earlier, suppose I have determined the functional currency because the selling prices were being determined in USD. Now, selling price started to be determined in INR and denominated in USD. Because earlier they were determined in USD. So basis on that, functional currency was USD. Now they are determined in INR but denominated in USD. So functional currency will be INR because the underlying facts and circumstances have changed. So functional currency will also change, right? Now, what will happen if there is a change? Only if there is a change in the underlying events and conditions, translation procedures should be applied to the new functional currency prospectively from the date of the change. So, suppose if the functional currency is changed on 14th of July in between the year, then from 14th of July, the transactions will start getting recorded in the new functional currency, right? That functional currency will become my new functional currency in which all the transactions needs to be recorded, right? And for all the past transactions, those are needs to be translated because at the end of the year, I have to present my financial statements in one currency only, functional currency. So for that, I will be doing the translation. Now, whenever there is a change in functional currency, then functional currency once determined can be changed only if there is a change to the underlying transactions, events, and conditions which determined the earlier functional currency of the entity, right? Otherwise, so I cannot change even. The change is only possible if underlying circumstances change, and I will, again check on all the conditions, primary as well as the secondary and the other four for the foreign operation, and basis on that, whatever the answer comes in, that will be the functional currency. So like I have taken an example, a change in the currency that mainly influences the sale price of the goods and services may lead to change in the entity's functional currency, right? Earlier, the prices were being determined in USD. So USD was the functional currency. Now the prices I have started, determining in INR. So INR would be the functional currency going forward. How the change is to be accounted for? Apply the translation procedures applicable to the new functional currency prospectively from the date of the change. So as and when the functional currency is changed, the translation procedures have to be performed in the new currency. Translate all items into the new functional currency using the exchange rate at the date of the change. So all previous items needs to be translated into the new functional currency, right? So if 14th June, I have changed my currency, or I have come to know that my functional currency is changed. So 14th June and onwards, all the transactions will by default or automatically will get recorded in the new functional currency. But the transactions prior to that period have to be, translated into the new functional currency. And any exchange difference arising from the translation of the foreign operation previously recognized in OCI are not reclassified from equity to the P&L until the disposal of the operation. So this is case of foreign operations. So whenever the foreign operations translation happens, so any translation reserve which was sitting in the OCI or equity does not get reclassified from equity to the P&L, and it gets reclassified only on the disposal of my interest in the foreign operation. And translated amounts of the non-monetary items are treated as their historical cost. So translated items will become the new cost. Right? So translation has to be done prospectively. If the currency of a hyperinflationary economy is the functional currency. Have you studied Ind AS 29? Just let me know yes or no. 29 studied or not? Namrata is asking, please share these notes. I have already shared, uploaded it on the portal. You can get download from there. So Ind AS 29 is the standard dealing with the hyperinflationary, economies. So whenever there is a hyperinflation in the country, how the financial statements will be prepared is, dealt by Ind AS 29. Right. Now you have said we have not yet studied. Okay. So let me set some context. So Ind AS 29 says whenever there is a hyperinflation. So hyperinflation, as the name suggests, is a high inflation, right? Which is super high. So inflation, say 5%, 6%, 10% is a normal inflation. Even for that matter, 15% is a normal, 20% might be abnormal, but not very significantly high, right? Now the standard says if the summation of the 3 years inflation exceeds 100%, then that country will be termed as hyperinflationary economy. Okay. Like for example, Zimbabwe, some time back, Russia was also in hyperinflation, right? So in those countries, what happens? Whenever we prepare the financial statements, so by the time we prepare the financial statement, we lose the money purchasing power, right? So for that, these financial statements, instead of getting prepared in their domestic currency, that is the currency of that country, they gets prepared in some other currency, stable currency. Stable currency. Okay. So maybe for example, dollar, right? So that financial statements needs to be prepared in some stable currency and denominated in all the transactions, purchase and sales are also recorded and denominated in that stable currency, so that users of the financial statements are able to make a sense out of that, right? So that is all the thing covered under Ind AS 29. Whenever you will study that standard, you will, read all those things in detail. But because here, this standard is also talking about a conversion or translation of the financial statements from one currency to another currency, and Ind AS 29 also talks about, to a limited extent, if there is a hyperinflation in the economy. Now, what this standard is saying, an entity cannot adopt functional currency other than that determined in accordance with this standard. Functional currency has to be determined in accordance with Ind AS 21 only. Okay. So indirectly, what this standard is saying, even if there is a hyperinflation in the economy, and if that economy's domestic currency, for example, Zimbabwean dollar. So if Zimbabwe is in hyperinflation and Zimbabwean dollar is the currency of the Zimbabwe, then as per Ind AS 29, in spite of the fact that Zimbabwe is in hyperinflation, functional currency will be determined in accordance with this standard, that is Zimbabwean dollar. In spite of the fact being a currency of the hyperinflationary economy, will continue to hold the status of the functional currency if it is determined as the functional currency as per the rules of this standard, right? If the functional currency of the entity is the currency of a hyperinflationary economy, it cannot avoid reinstatement in accordance with Ind AS 29 by selecting some other currency as its functional currency. Now, although the functional currency will anyway be the currency as determined by this standard, but reinstatement in any other currency as required by Ind AS 29, because Zimbabwean dollar is no more a stable currency. So Ind AS 29 says, boss, you need to prepare the financial statements in some stable currency. So reinstatement has to take place. So financial statements will be prepared in, say, USD dollar, but functional currency will be the Zimbabwean dollar only. Getting my point? So the limited interaction this standard is doing with Ind AS 29 is this only, that functional currency has to be determined by me, but because Ind AS 29 specifically talks about conversion of the financial statement from the unstable currency to the stable currency, and if that functional currency is the unstable currency, then okay, go ahead, apply Ind AS 29, reinstate the financials in other stable currency, no problem, right? Venezuela, Sri Lanka are suffering from hyperinflation, correct? Right? So this is the limited interaction, nothing more, nothing less. So that was all about the currencies. So under IGAP, we have never thought about this, all these issues, right? Functional currency, foreign currency, presentation currency, because under IGAP, INR was the domestic currency and we have been doing anything and everything in the domestic currency only, correct? We have been preparing financial statements in domestic currency, INR, submitting them everywhere in INR only. But now, because these are the global standards, they are designed from the global perspective. Hence, they have brought up the concept of presentation currency. They have brought up the concept of functional currency, and functional currency cannot be said to be a domestic currency. It has to be determined basis on the rules, right? That's what we have studied so far since morning. Now, monetary and non-monetary items. What are the monetary items? The essential feature of it is a right to receive or an obligation to deliver a fixed or determinable number of units of the currency. So monetary items which are denominated or can be denominated in determinable amounts of money. Determinable amounts of money, right? For example, cash is a monetary item. Debtors, right? Creditors, right? These are the monetary items. Lease liabilities, lease obligation, right? Non-monetary items other than the monetary items. For example, goodwill, intangible assets, inventories, property, plant and equipment, ROU assets recognized under Ind AS 16, prepaid expense, prepaid expenses, right? So all these items are non-monetary in nature because they do not have any feature of right to receive cash. So if I am having machineries in my factory, do I have the right to receive cash from somebody? No. But if I have debtors, do I have the right to receive cash from those parties? Yes. Creditors, I have the obligation to pay. Lease, I have the obligation to pay. Cash is anyway cash. So cash is always a monetary item. Bank balance is a monetary item, right? Now, let's move on to the first requirement of the standard. Till now, we have been studying the definitions, concepts. Now the requirement is reporting of the foreign currency transactions. How the transactions which are taken place in foreign currencies, for example, sales made in foreign currency, purchases made in foreign currency, machinery purchased in foreign currency, loans taken in foreign currency, loans given in foreign currency. So all such transactions, how they will be accounted for and presented, right, or reported. Now, what is the definition? It is the transaction that is denominated or requires settlement in a foreign currency, right? So this transaction is taking place in the foreign currency or requiring the settlement in the foreign currency. For example, transactions arising when entity buys or sells goods or services whose prices are denominated in the foreign currency, borrows or lends funds from when the amounts are payable or receivable are denominated in the foreign currency. For example, ECB, external commercial borrowings, are foreign currency transactions. Otherwise, acquires or disposes of assets or incurs or settles liabilities denominated in a foreign currency. For example, import of machinery. Right? Initial recognition recorded at initial recognition in the functional currency. Right? So we have to recognize the transaction in the functional currency by multiplying the foreign currency amount of the transaction into the spot rate between the functional currency and the foreign currency on the date of the transaction. On the date of the transaction. So spot rate on the date of the transaction. These are the key words, right? And this is same what we have been doing under ICAI as well. So as such, there is no difference. So whenever we record any transactions in INR, which happened in US dollar, those transactions needs to be converted into the INR by applying the spot exchange rate on the date of the transaction. So if I made the sales on 1st of January, then 1st of January spot rate. If I purchased, something on 10th of July, then 10th of July spot rate needs to be considered, right? So this is the simple rule, which is nowhere different from the ICAI, whatever we have been doing under ICAI. Now, subsequent reporting. So this is the day one reporting. Day one reporting. Initial recognition means day one, when the transaction happened. Okay. Now, subsequent reporting at the end of the reporting period. That is at each reporting date. At each reporting date. For example, 30th June, 30th September, 31st December, 31st March, right? So these are generally the reporting dates on which we prepare the financial statements. So on these dates, what will happen? For monetary items, translated using the closing rate. So monetary items means debtors, creditors are all reinstated, right, at closing rate. That is, closing rate means the closing rate on the reporting date, right? Such exchange difference is recognized in the P&L on the reporting date. So always in P&L, right? Never in OCI. Okay? Always in P&L. Clear? Same what we have been doing under ICAI too. No difference. Now for non-monetary items, for example, PP&D, intangible assets, or inventory. Okay. Measured in terms of the historical cost in the foreign currency. Then translated using the exchange rate at the date of the transaction only. So no further reinstatement. So it means no reinstatement. Right? And if measured at fair value, NRV, recoverable amount in the foreign currency, then translated using the exchange rates at the end of the reporting period. Now, who will tell me what is the difference between these two? Measured at historical cost and measured at fair value or NRV. Now, let me give you an example. For example, let me find some white space. Okay. I'm just using the white space on this slide. So, Ind AS 16 gives us two accounting policy choices. What are those? Cost model and revaluation model. Yes or no? Yes. Are these accounting policy choices? Yes. If I change from one cost model to revaluation model, will that be required to account for as change in accounting policy? Yes, under Ind AS 8. Okay. That you must have already studied. Now, if the company has adopted cost model as an accounting policy choice for Ind AS 16, and I have purchased a machinery from US, right? So what would I have accounted for on day one? Suppose $5,000 was the cost of that machinery and 80 rupees is the rate on the date of purchase. So I would have debited PP&E account debited to supplier, right? How much? Three zeros, 4 zeros, 5 zeros, 6 zeros. So 4 lakh. By 4 lakh, I would have debited the cost PP&E to supplier. Yes or no? Till now, I'm not talking about anything new. This we have been doing since class 12th. Yes or no? So this is the historical cost, and I have converted on the rate, spot rate on the date of the transaction, which is 80, right? Now, Ind AS 21 says, because PP&E is a monetary item, right, and recorded at historical cost, right? So it is not required to be revalued, right? So it will continue to be recorded under the cost model at the historical cost. So this cost of 4 lakh is, crystallized in this case as per Ind AS 16. Okay. Now Ind AS 21 says that if non-monetary item, for example, PP&E, had been recorded at historical cost, then they are translated using the exchange rate on the date of the transaction only. That is no reinstatement on the reporting date. Yes or no? No reinstatement on the reporting date. So no further reinstatement. Whatever was done on the initial recognition date will continue in the books at each reporting date. No change. Is it clear? Now, what if instead of adopting the cost model, the company would have adopted the revaluation model? Then in that case, this PP&E needs to be revalued at reasonable frequency, if not on each reporting date. Yes or no? Yes. Suppose company has a policy of revaluing the property, plant and equipment, say every year. Now, on 31st March, sorry, just give me a second. On 31st March, now company is revaluing this property, plant and equipment, or this machinery basically. Now, company, asks the valuation team or the valuer to, help out in doing the valuation. Now that valuer is doing the revaluation of this property, plant and equipment and came up with certain valuation. Now, if there is any downward valuation, then that will be recorded in the P&L. So if the valuation goes downward, so there could be two scenarios, downward and upward. So if it goes downward, it will go to the P&L. And if it goes upward, it will go to the OCI, right? This revaluation, this you must have already studied under Ind AS 16, right? Now, Ind AS 21 says that when measured at fair value, then translated using the exchange rate at the end of the reporting period. So in that case, this fair valuation as on 31st March will be, including the effect of gain or loss made on the foreign exchange between the two dates, that is the initial recognition date and the reporting date as well. So this gain or loss on the exchange will be subsumed within this fair valuation. Getting my point? This is what Ind AS 21 is saying here. Now, next point, standard is saying if gain or loss on the non-monetary item is recognized in OCI, then exchange component will also go to OCI, and if gain or loss is recognized in P&L, then exchange component will also go in the P&L. Now, in this case, if the movement is the downward movement, then fair value gain or loss goes to P&L. So exchange gain or loss will also go to the P&L. If the movement is upward movement, then fair value gain or loss goes to OCI, then exchange gain or loss will also go to OCI, which is in contrast with the rule for the monetary items. So for monetary items, it will always go to P&L, right? And OCI cannot be used for monetary items ever. But for non-monetary items, it depends. If fair valuation gain or loss goes to P&L, then P&L. If goes to OCI, then OCI. Am I clear on this? Any doubts? So here it is. So non-monetary assets, for example, PP&E, intangible asset, inventory, right? If fair valuation gain or loss is recognized in P&L, then exchange component will also be recognized in the P&L. If fair value gain or loss is recognized in OCI, then exchange component also to be recognized in OCI. That is the standard is asking us to do. Please let me know if it is clear to you. Any doubts, questions, queries you might have, please ask. I am happy to take it up. If it is clear, just let me know. I can proceed. Okay, Viraj, Abdul, Namrata, and Shruti are confirming it is clear. But Namrata is asking, please give an example on revaluation model. Okay. Revaluation model. Example. PP&D, say machinery. Right? Initially, it was recorded, say, for 10,000. Now, since accounting policy adopted by the company is the revaluation model, it needs to be revalued. Now the company comes up with the revaluation with say 12,000 and 8,000. Okay. Abhi, I am talking about Ind AS 16. Okay. 16. Okay. Now in this case, 2,000 will go to OCI. Because standard says whenever there is a upward revaluation, it will be going to the OCI. And if there is a downward revaluation, then this 2,000 will go to the P&L, right? This is the revaluation model accounting prescribed by Ind AS 16, right? Now, if this machinery, 10,000, this machinery was actually purchased in say from other country, say in foreign currency, right? In foreign currency. Now, because this was purchased in foreign currency, so this 10,000 must have been derived by converting the dollars into the spot rate, right? So this 10,000 would be equivalent to say 4 lakh in our example, which I have taken previously. So 4 lakh was recorded here. Now, on the date of revaluation, this gap of 2000, this 2000 might be having two components. Component 1 and component 2. This component 1 might be because of change in prices, change in real value, or change in real value of machinery, right? And component 2 because of change in forex. For example, if I had purchased this machinery in 2021, at that time forex was 80, but if I purchase this machinery now in 2023, say forex is 85, right? So 5 rupees delta is because of component 2. Now, Ind AS 21 is saying, boss, if original movement goes to OCI, then exchange gain or loss will also go to OCI. And if original movement goes to the PNL, exchange gain or loss will also go to the PNL. Now, the total movement is 2000, constituting both the items. Component number 1, real increase in the value of the machinery, because earlier the machinery was say X rupees. Now because of inflation, machinery is now X plus 1. And the component 2, the forex fluctuation. Earlier, if I had purchased X at 80, now I have to purchase X1 at 85. So X1, the one difference is on account of general inflation or general change or general, increase in the price of the machinery, and component 2 is because of the forex fluctuation, right? So these two fluctuation constitutes the overall fair value change, because fair value change means fair value captures all effects on account of change of anything. So number 1 effect is forex and number 2 is others. So if others is going to OCI, then forex will also go to OCI. That's what the standard is saying. Namrata, I have explained what you have been asking for. If it is clear, let me know. Yedu Kondulu is saying, please repeat when to change P. What is P? And Kishan is asking, what will be the criteria to take in P? Sorry, what is P? Okay. Anything else anybody wants to ask before we proceed further? Okay. Key point which we need to keep in our mind: for practical reasons, a rate that approximates the actual rate at the date of the transaction is often used. For example, an average rate for a week or a month. However, if exchange rates fluctuate significantly, the use of the average rate for the period is not appropriate. What does this mean? This means, suppose if company is doing the purchase and sales almost on a daily basis in the foreign currency. So instead of, fetching the daily closing rate for recording those daily sales purchase transactions, what the company can do, they can use a weekly average rate or a monthly average rate if fluctuations are not significant. If fluctuations are not significant, right? But if fluctuations are significant between the forex rates, then these average rate, that is the weekly average or monthly average, cannot be used, right? Cannot be used if the fluctuations are significant. So then in that case, we have to record the transaction, on each day's closing rate, that is the spot rate closing rate, right? And if the fluctuations are insignificant, weekly average or monthly average can be used for the sake of simplicity for recording all the sales or purchase transactions in that particular month. For example, June's average rate, we have calculated, say, $82.5. Then $82.5 will be used for all the transactions taken place in the June, right? If the fluctuations are not significant. Okay. So in the previous question, Namrata is asking, do we need to bifurcate these two components? So as such, there is no requirement to bifurcate unless and until specifically asked in the question. Because in examination, if the question comes up to check on this concept, then definitely for examination, you need to show up that bifurcation basis on the facts given in the question. But in practical life, as such, we are not supposed to bifurcate. But yes, for the purposes of making disclosures, we disclose what is the effect of the forex fluctuation, right? So in P&L, we don't need to bifurcate in practical life. But for examination anyway, because examination question is specifically coming up to check on this concept, you have to show up the bifurcation. So Manoj is saying it means loss of profit not to affect either valuation is downward or upward. Of course, so profit and loss, so if the movement is upward, it will go to OCI. If the movement is downward, it will go to the P&L. So that is a Ind AS 16 concept. Ind AS 21 has nothing to do with that. Right, Manoj? You just revise Ind AS 16 revaluation model and it will be cleared. Okay, let's do this question. A French entity purchases a equipment on credit from a Canadian supplier. So purchaser is the French entity and seller is the Canadian. For Canadian dollars, 328,000 in January 2015. When the exchange rate is 1 French dollar equivalent to 1 Canadian dollar of 1.64. The entity records the asset at a cost of 2 lakh euros. Basically, this is euros, right? That is 328,000 divided by 1.64 at the French entity's year end at 31st March 2015. The account has not yet been settled. The closing rate is this much on the year end. What we need to do in our books? So first is there is a payable. Second is there is a machinery. Payable is a monetary item and machinery is a non-monetary item, right? Now, let's talk about first monetary item. So because this is a creditor, payable, monetary item, that needs to be reinstated, remeasured at the closing rate, right? The amount payable would be retranslated at 2,03,727 euros. That is 2 lakh euros into 1.64 divided by 1.61 in the balance sheet, and an exchange loss of this much would be recognized in the P&L for the period. Is this clear? So simple reinstatement of the creditor balance as on 31st March, because that is not yet settled. had it been settled, there was no question of doing the remeasurement, right? Because there is no more any liability in the balance sheet. But since it is not yet settled and closing date of my financial statements have arrived, so in 31st March financials, I have to report my creditors at their real worth or real liability, and real liability takes into account the forex exchange gain or loss as well, right? So that needs to be reinstated. Same we have been doing under ICAI, no difference, right? So this is remeasured and reinstated. And for monetary item, I have always said, for monetary item, where the fluctuation gain or loss goes, always P&L, right? So it will go to the P&L. Now, for the non-monetary item machinery, no changes. The cost of the asset would remain itna, euros 2 lakh, right? Because entity records the asset at cost, so they have applied the cost model. So if they have applied the cost model, there wouldn't be anything to do under Ind AS 21 for that. Clear? Let's do one more. A UK entity sells goods to the German entity. So UK is the seller, German is the buyer. For euros 87,000 on 28th of February 2051 or 2015, when the exchange rate is 1 GBP pound to euros 1.45. It receives payment on 31st March 15 when the exchange rate is this much. On 28th of February, the UK entity will record a sale and a corresponding receivable of 60,000 pounds, correct? When the payment is received on 31st March, the actual amount received is only how much? 58,000 pounds. Now, in this case, settlement is happening on the reporting date only. So what will happen? Loss of exchange of 2,000 pounds will be reported to the P&L for the period. Yes or no? Because I would have received 60,000, but because on 31st March rate was this much, and because of this I have received 2,000 short. So this is the exchange gain or loss on the settlement or on the realization. So this will be recorded in the P&L. So whether it is a gain, realized gain, or whether it is a gain, unrealized gain, or realized loss or unrealized loss. So whatever it would be on the monetary item, it will always go to the P&L. Realized oblique unrealized or gain oblique loss, whatever, everything goes to the P&L on monetary items. Clear? Please confirm if it is clear, or if you have any questions, let me know in the chat box. Okay, Viraj and Abdul, thanks for the confirmation. Now it's your turn to try your hands on the question. Warrior has a reporting period ending 31st December 2015. On 29th of November 2015, Warrior received a loan from an Australian bank of Australian dollars of 15,20,000. Okay. The proceeds are used to finance in part the purchase of the new office block. The loan remains unsettled as at 31st December 2015, which is the reporting date. Exchange rates on the two dates are given. Required journal entries for these transactions. Tell me, what is the journal entry on 29th November and what is the journal entry on 31st December in the books of the Warrior? Waiting for your response in the chat box. Bank to loan 10 lakh rupees. Namrata is saying, okay. Kishan is saying bank account debit. That's it. No credit, only debit. Viraj is saying, sir, loss on forex account debit 1,40,000. To loan account 1,40,000. Okay. Muhammad Abdul Rahim is saying 29th November bank account debit to loan account 10 lakh US dollar. Okay. So Kishan Kumar is saying bank account debit Australian dollars 15 lakh 20,000 to loan payable Australian dollars 15 lakh 20,000. Okay. So you doing the accounting in Australian dollars, Kishan? Namrata is saying on 31st December, loan to foreign exchange gain is 84,337. Okay. Let's see. So on 29th of November, bank account or cash account debit to loan account 10 lakhs, 10 lakhs. That is the correct entry. All have came up with this. And then loan account debit to credit P&L account 84,000, 84,000. So how this calculation is done? 15 lakh 20,000 divided by 1.52. So this is the 10 lakh initial loan amount in my home currency or the functional currency, and then reinstated at 1.66. So the liability is now restricted to 916. So delta is 84. So 84 is my gain, which will be recorded in the P&L. Why in the P&L? Because this is a monetary item. Right? Clear? $10 lakh credit from the Australian dollar or 10 lakh. Correct. So this was the simple question. Now, as we have spoken about the translation of the financial statements from one currency to another currency, this could be in two situations. Right? Situation number one, situation number two. When I want to prepare additional set of financial, ADDITIONAL, additional set of FS in presentation currency. Right? So although I am preparing one set in functional currency, but additionally I want to prepare in some other currency which will be regarded as presentation currency. So then from functional currency to presentation currency, this translation approach needs to be followed. And another, for preparing my consolidated financial statement, I need FS of my foreign operation in same currency. Right? So either the foreign operation will be preparing the financial statements in the same currency as I am preparing, or they will prepare one more additional set. So if the foreign operation was preparing the financial statement in say dollars, now I have been consolidating in INR. So their financial statements needs to be translated from dollar to INR for the consolidation purpose. So again, the translation approach needs to be followed, right? Now, what is the translation approach? So translation approach is assets and liabilities for the current period. Now we prepare the financial statements for the two periods, current period and the previous comparative period. Now, for the current period, how the translation will take place at the closing rate, that is the current balance sheet date. And for the comparative period, how the translation will take place, closing rate at the comparative balance sheet date. So if I'm preparing 31st March 23 financials, so this would be 31st March 23 and this would be 31st March 22. Clear? Assets and liabilities, all the balance sheet items, all the equity items, current period, actual rates, as and when those transactions have taken place. For example, dividends declared, dividends received, equity shares issued, equity shares bought back. So all those transactions, equity related transactions or items will be at the actual rates or an appropriate average rate for the current and the comparative period, right? Actual date, transaction date, income and expenses, including those recognized directly in equity, current period, actual rates or average rate for the current period and comparative actual rates or appropriate average rate for the comparative period, right? And any exchange gain or loss difference, separate a component of equity, reclassify to P&L on disposal in case of foreign operation. So this will be regarded as foreign currency translation reserve, FCTR. It will be sitting in other equity. Okay, this is one of the reserve. And when we dispose of the foreign operations, right, we sell the foreign operations. So any gain or loss from this FCTR sitting in other equity will be reclassified to P&L in the year of the disposal or sale of the foreign operation, right? Until then, it will continue to accumulate in foreign currency translation reserves, part of the other equity. The guidance provided on determining an entity's functional currency equally applies to the determination of the functional currency of the foreign operation of the entity, that we have already discussed and covered. These are just, points which we need to keep in our mind. Effectively, the translation procedures, those for translating foreign operations, are the same as those followed when the entity presents its financial statements in a presentation currency that is different from the functional currency. So what it is saying, see, there are two scenarios. Either I am preparing my own set of financial statements in any other currency over and above my functional currency, then I need to translate my financial statements from my functional currency to the selected presentation currency. Then translation approach has to be followed. And if I am preparing the consolidated financial statements, I need my foreign operation, foreign subsidiary, foreign associate or foreign JV's financial statements in the same currency. So I will be asking them, boss, come up and prepare the financial statements in my functional currency and send it to me for fit for consolidation, right? So both these translations have the same approach. That's what the standard is saying. So as such, there is no difference, right? In addition to the exchange differences as stated above, the foreign currency translation reserve may include exchange differences arising from loans that form part of the parent's net investment in the foreign operation and the gains or losses related to the hedges of the net investment in the foreign operations. These topics we will discuss in detail going forward. So for the time being, don't get confused that what is this complex, words are being written here. For the time being, just understand that there could be certain additional items leading to the foreign exchange translation reserve and item number 1 and item number 2. Right. And these items we are going to discuss in detail. We will do some practicals around that as well. Unless and until I crystallize the concept in your mind, I will not leave you. Don't worry. Now, let's understand. So here they are talking about net investment, parent's net investment in the foreign operations. So let's understand what this term is all about. Net investment in a foreign operation. Okay, let's understand this first. What does this mean? Net investment in foreign operation is the amount of the reporting entity's interest in the net assets of that operation. What do you mean by that? Suppose if a company has set up a foreign operation, now company is holding say 75% of the equity interest in that foreign operation, then it means company is having a 75% interest in the net assets of that operation, yes or no? Yes. So whatever interest I am having in that foreign operation, that will be considered as net investment in that foreign operation. A monetary item receivable from or payable to a foreign operation may form part of the net investment in the foreign operation if the settlement of the monetary item is neither planned nor likely to occur. Now, whenever I say keywords, please focus. Keyword number 1, neither planned. Nor likely to occur. Keyword number 2, keyword number 1 and keyword number 2. Right? We have to remember these keywords because this will play a significant role in our assessment whether a transaction will form part of net investment or not. Right? Now, long-term loans given to the foreign operations will be treated as net investment in the foreign operation if settlement is neither planned nor likely to occur in the foreseeable future. Okay, now let me find some white space. Okay, here. There is a company, parent company. So parent company is say H Limited in India. Okay. And its functional currency is INR. That is already determined basis on the rules, right? These are the facts. Now there is a subsidiary S Limited. Set up where? In say US. Okay. And their functional currency is say US dollar. That is determined as per the rules. Possible or not possible? Possible. Now, because H Limited is the holding company and this is the subsidiary company, which is a foreign operation as well for us. So H Limited will have certain transactions with S Limited. So there are two types of transactions. One, which will be forming part of the net investment, and others which will not form part of the net investment, right? So net investment means that H Limited is not asking S Limited to pay back for anything. So this is a simple investment in the S Limited. For example, H Limited has given a long-term loan of $100 million. $100 million. Okay. H Limited has given a long-term loan to S Limited of $100 million. Now, this $100 million loan has no repayment plan. No repayment plan. Okay. And nor it is due for repayment. Nor it is due for repayment. For repayment. What does this mean? This means that this $100 million is just invested by H Limited in S Limited, or they have given some funds so that S Limited can operate there in the US, right? So that is the investment made by H Limited in S Limited in the form of loan, rather doing in the form of equity. Possible or not possible? There are two types of funding I can give to somebody. Either I can give a loan, or I can, purchase the shares, or I can, ask them to issue the equity, right? So H Limited has given $100 million loan, which is not planned for any repayment, and neither it is planned for repayment nor it is due. So it means it is a net investment in the subsidiary by holding company in the subsidiary limited in the form of net investment, right? So that's what the standard is saying. So this transaction will be considered as net investment in the foreign operation, right? Net investment in the foreign operation. Now, another transaction. H Limited is selling goods. Selling goods to S Limited. Okay. For, say, $10,000. Okay. And H Limited recorded S Limited as a debtor for that. And S Limited recorded H Limited as a creditor for that. Right? And this payment is due as per the general credit terms, which are there by H Limited for all of its customers. Now, whether this transaction will form part of the net investment, tell me in the chat box, yes or no. Because this is a trading balance. This is a trading balance. Trading balance. Right? For day-to-day transactions happening between H Limited and S Limited. Right? So this cannot be said to be a net investment. Right? Why? Because it is not meeting the condition of no repayment plan, or nor it is due. So it is due as well as it is expected to be repaid, because I have sold the goods, I have debited the S Limited as a debtor, and S Limited has an obligation to discharge that obligation, and I'm expecting S Limited to, pay me for the goods I have supplied to them. So this is an expectation here. This is a trading happening between the two entities. So this transaction is called trading transactions, right? So trading transactions are always expected to be settled within the due course, right? So they are not transactions expected not to be settled or nor planned to be settled, right? So if that would be the case, then only it will take the color of net investment. Otherwise, they have to be settled because they are due, say for 3 months, 6 months from now, then they are trading balances and they cannot be regarded as net investment in the foreign operation. Am I clear till now? Correct? Now, what the standard is saying? The standard is saying, boss, net investment in foreign operation is the amount of the reporting entities. Reporting entity means parent entities, P, interest in the net assets of that operation, right? In the net assets. So whenever P intends to liquidate its investment, what it is entitled to? It is entitled to its share of net assets. Yes or no? Its share of net assets. So that is called the net investment in the foreign operation. Now, a monetary item that is receivable, that is debit balance debtor, or payable, that is credit balance creditor, right? To a foreign operation may form part of the net investment in the foreign operation if the settlement of the monetary item is neither planned nor likely to occur. Neither planned nor likely to occur. So if for any of the trading balances, I have agreed with the subsidiary or the foreign operation that, boss, whenever I sell any goods to you or I send any, supplies to you, I expect no obligation to be discharged and it is to be treated as a investment by me in your company. If that agreement is already there in place as a master agreement for all such trading transactions, then only these trading transactions will take the color of the net investment. Yes or no? So as and when holding company sends goods to the foreign operation subsidiary, they will take the color of the investment made by the holding company into the foreign operation, because as per the master agreement between the two, these are not planned to be settled and they are not due to be settled, right? So only in that case, they will be treated as net investment, otherwise not. So by default, all the trading transactions happening between the two companies will not form part of the net investment in the foreign operation unless otherwise stated. Clear? Till now, it's making sense? Are we on same page? Now, trade receivables, trade payables are not to be considered as net investment in the foreign operation in general, unless otherwise specified, right? And long-term loans, which are neither planned, that is, there is no repayment schedule agreed at the time of giving loans, and they are not demanded or due, by the holding company from the foreign operation in foreseeable future, right? Then only they will be treated as net investment in the foreign operation. So till now, we have tried to discuss and understand the definition of net investment in the foreign operation through this slide and examples. Now we will go back what the translation approach was telling us. Translation approach was telling us, in addition to the exchange difference as stated above, the foreign currency translation reserve may include exchange difference arising from loans that form part of the parent's net investment in the foreign operation. So if any such long-term, ultra long-term loans which are not planned to be repaid in the foreseeable future, hence to be treated as net investment, but still they needs to be reinstated, because anyway I have to reinstate while preparing the year-end balance sheet, right? So these loans will also required to be reinstated. Hence on these loans as well, there would be foreign exchange gain or loss which will arise or may arise, that will also be form part of the foreign currency translation reserve. That is the translation approach is saying. Gains and losses related to the hedge of the net investment in the foreign operation. And if this net investment is hedged, then gains and losses on those hedges as well will form part of the transactions. Now, let's do the question first. Then I will come back to the chart, pictorial presentation. I know it's a few minutes over, but let me, just complete the concept which is in flow at this time. I'll wind up the session soon. Functional currency of the parent P is euro, while the functional currency of the subsidiary S is US dollar. Okay. P sells inventory to S. Now, P is the parent company. This is selling goods to S, subsidiary company, right? Selling goods. For the same was made for how much? US dollar 300. Oh. So P's functional currency, although is in euros, and P is selling goods to subsidiary, but they are invoicing these goods in which currency? In US dollar. So USD 300. Okay. Which is the functional currency of S during the year. At the year end, a balance of the same amount is outstanding as a receivable from S. Right? So by the year end, subsidiary has not yet settled or made payment for this purchase to the holding company or parent company. It has been observed that such balance amount has been continuing as a receivable from S year on year, and even though the payments in respect of these balances are expected to be received in the foreseeable future, but if we look at the year end, then we see this balance as outstanding every year. What the question is saying? It has been observed that whenever such transactions happen, they are not getting settled by the subsidiary, right? Although they are expected to be settled in the foreseeable future. So as such, there is no contract or master agreement that these transactions are not expected to be settled. But when we see the historical data for last 3 years, 5 years, 10 years, we found that they are never settled. That is the fact in the question. In addition to the trading balances between P and S, P has lent an amount of $500 to S that is not expected to be repaid in the foreseeable future, right? Not expected to be repaid in the foreseeable future. Should the exchange difference, if any, be recognized in the P&L? So, before answering whether the exchange difference will be recognized in the P&L or not, answer first whether the trading item, that is the sell of goods to the subsidiary, is a net investment or not, and the loan is a net investment or not. So which item is a net investment and which is not? First answer this aspect. Thanks, Shruti, for the appreciation. I'm just waiting for your response. So you need to answer, sale of goods is a net investment or not a net investment? Loan given is a net investment or not a net investment by the P into S. First answer this aspect, then we will discuss the next aspect. Both inventory and loan are part of investment. Abdul is saying. Yedu Kondu is saying sales receivable. What sales receivables? I'm asking, sales receivable is net investment or not? Loan is net investment or not? Namrata is saying loan given is the net investment. What about the sales and the receivables? Sales receivable is net investment or not? Yedu Kondu is saying loan given is the net investment. Okay. Kishan Kumar is saying sales part is not net investment as it is expected to settle within the due date, even if not getting settled. Okay. Viraj is saying, sir, balance is outstanding year on year part of the investment. So Viraj is saying that because it is outstanding year on year basis and it is not getting settled, so we can safely assume that this is a net investment. Okay. Namrata is saying trade receivable also part of the net investment. Okay. The exchange gain or loss will arise in the books of the accounts of P in respect of the trading balance with S. The same should be recognized in the P&L. So, okay. This being the balance for in the nature of the trade receivable for P, it would not be considered as net investment in the foreign currency S. Foreign operation S. Would not be considered as net investment. Would not be considered as net investment. Why? Let's go back to the keywords which I had highlighted. What were those? Number one, neither planned nor likely to occur. right? So if something is neither planned to be repaid by the foreign operation nor likely to due or occur for repayment from the foreign operation, then only it will be treated as a net investment. But now, in the facts of our question, what it was saying, it has been observed that such balance amount has been continuing as receivable from S year on year, even though payments are in respect of these balances are expected. Are expected means they are planned, right? They are planned to be received. Planned to be received. So H Limited has not entered into an agreement or contract with the foreign operation that these are not expected to be settled. They say these are expected to be settled, but foreign operation is not settling it and H Limited is not forcing it to settle. But there is as such no contract or, arrangement or agreement that this is not due or this is not expected to be settled. So if this is not expected to be settled and not due, then only it will be regarded as investment, net investment in the foreign operation. But if it is not getting settled, but it is expected to be settled, then it cannot be regarded as net investment in the foreign operation. Clear? So Kishan Kumar is saying loan is a part of net investment and as it's not expected to be repaid in foreseeable future. Perfect. Yedu Kundi is saying sales receivable, not net investment, and sale is trading, loan is investment. Correct. Shruti is saying and Manoj is saying yes, net investment. So now, whenever anything is not expected, that is, the keyword is neither planned nor expected to be settled, then only it will form part of the net investment, otherwise not. Correct? In the foreseeable future. Now, to answer the remaining portion, what will go to the P&L, what will go to the OCI, when it will go to the P&L, when it will go to the OCI, we need to understand this chart. Now, once we are decisive what is net investment and what is not. So for net investment in the foreign operation, when exchange difference arising on monetary items forms part of a reporting entity's net investment in a foreign operation and is denominated in the functional currency of the reporting entity. Reporting entity means the parent company, right? Now, if it is denominated in the functional currency of the parent. Now, in our example, what was happening? Parent was having the functional currency euro, but they were invoicing in USD, which is a functional currency of the subsidiary. So is this case falling here? In the first case, no, because it is not happening, transaction is not happening in the functional currency. It is happening in the functional currency of the foreign operation. So it is falling here, right? Now, in this case, what we will do? Exchange difference arises in the foreign operations of the individual financial statement. Individual means standalone financial statement of parent. And because this transaction is not, happening in the functional currency of the reporting entity, and rather it is happening in the functional currency of the subsidiary, that is the foreign operation. So exchange difference arises in the reporting entity's separate financial statements, right? So parents separate, SFS. This is foreign operations, SFS. Now, if it is denominated in the currency other than the functional currency, either the reporting entity or the foreign operation, right? So suppose in our case, let me write the facts here. So holding company parent and subsidiary company foreign operation. Okay. it has a functional currency, say INR, and it has a functional currency, say US dollar, and the transaction is happening in, say, euros, then it will fall in this case. If the transaction is happening in INR, that is functional currency of the parent, then it will fall here. And if the transaction is happening US dollar, that is the functional currency of the foreign operation, then it will fall here, right? These are the possible three situations or scenarios. Now, if we are falling here, what we need to do? We will record a exchange gain or loss in the standalone financial statements of the foreign operation. If we are falling here, we will record exchange gain or loss in the standalone financial statements of the parent. And if we are falling here, then exchange difference arises in both the reporting entities, separate financial statements, and the foreign operations individual financial statements. So here both will record. So P as well as will have forex gain or loss. Forex gain or loss, because transaction is happening in some third currency. So if it is happening in third currency, then both will be recording the gain or loss. Now, all such gains or loss will go to the P&L in the respective financial statements of these entities. Right? Clear? So, whenever there are any trading transactions happening, right? And if it is happening in the functional currency of the parent, then we are falling here. Functional currency of the parent, then we are falling here. So, foreign exchange and gain or loss will arise in the financial statement of the foreign operation. If it is happening in the functional currency of the foreign operation, then financial statements of the parent will be recording the gain or loss. And if third currency, then both will be recording gain or loss. But whatever be the situation, gain or loss in these respective financial statements will go to the P&L. Clear point till now? In the chart, first, Namrata is saying first, second point not clear. First and second, okay. So, there could be three scenarios. Scenario number one, transaction is happening in the currency, functional currency of the parent. Scenario number two, transaction could be happening in the functional currency of the foreign operation. Scenario number three, transaction could be happening in the third currency, that is any other currency other than the functional currency of the parent as well as other than the functional currency of the foreign operation. So if that is the case, third currency case, so in this case, both the parent as well as foreign operation will be having the exchange gain or loss because transaction is happening in third currency. But if the transaction is happening in functional currency of the foreign operation, then because functional currency of the foreign operation is what in which the transaction is happening, so foreign operation will not have any exchange gain or loss, correct? Because that is the functional currency of that foreign operation. So in that case, only parent company will record the gain or loss in their standalone financial statements. Right? And if transaction is happening in the functional currency of the parent company, then because parent company functional currency is what in which the transaction is happening. So for parent, there is no exchange gain or loss because parent's functional currency is INR, transaction is happening in INR. So no gain or loss in the parent's books. So in the foreign operations books only, there will be gain or loss in a standalone financial statement. This is, I think, very easy to understand. Is it clear now? Okay. So Namrata is saying how to know transaction is happening in which currency. Oh, that is value that will be available in the question only now. Here is the question which we have been doing. So this question is saying functional currency of the parent is euro, functional currency of the subsidiary is dollar, and P sells inventory to S and transaction for the same was made for USD 300. So USD 300 that is happening in USD. So that is the fact which will always be there in the question. Right? We don't need to determine the currency in which the transaction will take place. That will always be given in the question. We only need to see what is the functional currency of the parent, what is the functional currency of the foreign operation. And if transaction is happening in the functional currency of the parent, then no gain or loss for the parent. If transaction is happening in the functional currency of the foreign operation, then no gain or loss for the foreign operation, right? Now let's get back to our question. Now the question was, should the exchange difference, if any, be recognized to P&L? Now the answer is, the exchange gain or loss will arise in the books of accounts of P. Why P? Because P has the functional currency of euro, and S, that is the foreign operation, has the functional currency of US dollar, right? And transaction happened in US dollar, 300 US dollar, right? So P will have the exchange gain or loss. Yes or no? Because transaction is happening US dollar, which is the functional currency of S. So S will not have any exchange gain or loss. Now, chart says it will go to P&L. So we will record it in the P&L. Will be recognized in the P&L. Now, amount lent by P should be regarded as its net investment in S, that is the foreign operation, because that amount was not due in the foreseeable future. Given here, sorry, here it is USD 500, and again the transaction is happening in which currency? USD. So P will be having the exchange gain or loss. So recognized in P&L in the P's separate financial statements and in OCI in the consolidated financial statements. Now P will be preparing two set of financial statements. One is the SFS and another is the consolidated CFS. Now, so far we have understood that any such gains or losses have to be recorded in the P&L, in the separate financial statements, right? Here it is the chart. Separate financial statement, separate financial statement, separate financial statement. So P&L. Clear? So we are doing the same. So we will be recognizing this gain or loss in the separate financial statements of the parent company P in the P&L. But when P prepares the consolidated financial statement, so P as well as comes under the same roof or same umbrella, right? Now they are single entity, right? So can I give loan to myself? Can I do a transaction with myself? No. So in that case, on consolidated basis, all these forex exchange gain or loss will go to the OCI. Getting my point? So when standalone financial statements are concerned, they will go to the P&L, respective P&Ls. Okay. And when consolidated financial statements are being prepared by the parent company, it will be foreign exchange gain or loss will be going to the OCI. Clear point? Here is the chart. In consolidated financial statements, which includes the foreign operation and the reporting entity both, right? Such exchange differences shall be recognized in OCI. And whenever foreign operation, then it will be reclassified from equity to P&L as a reclassification adjustment. So until disposal, it will be recording it in OCI. That is called foreign currency translation reserve. Foreign currency translation reserve, and year on year basis, whatever the fluctuations are will, get accumulated in this. And suppose in 2030, now the parent decides to sell this investment in the foreign operations, right? Now in that 2030 year, this FCTR balance will be reclassed to the P&L for that year, right? Okay, quick recap. No more concepts, no more practicals, just a recap of this concept. So, net investment in foreign operation means investment made by the parent company in the foreign operation, correct? That could be in the form of equity shares, that could be in the form of long-term loans given by the parent company to the foreign operation subsidiary company, associate company, or JV company, whatever it is, and which are neither planned nor expected to occur, neither planned and nor likely to occur in the foreseeable future. That is called net investment, right? If they are planned to be repaid, or they are expected to be repaid, then it can never be called as net investment in the foreign operation. They will simply be treated as trading balances, liabilities, or debit balance or credit balance, whatever it could be, right? So they will not be net investment, correct? This is the one concept which we have understood. Now, any exchange gain or loss, be it in the separate financial statement of the parent company, or be it in the separate financial statement of the foreign operation, it will go to the P&L by default, right? But if parent company prepares the consolidated financial statement, then such exchange gain or loss will go and accumulate in a reserve called as foreign currency translation reserve, and it will be recognized in OCI year on year basis, and it will continue to be there until the disposal happens in the net investment of that foreign operation by the parent company. In that year in which disposal of interest happens, then this FCTR will be reclassified to P&L for that financial year. That's what we have discussed and understood so far. I can take a pause here to see if you have any questions or doubts on this. Otherwise, I am happy to wind up the session now for today, and we will continue tomorrow on this. So let me know in the chat box if you have any questions. I'm waiting for a minute, and then we will wind up. Or if it is clear, just let me know it is clear so that I get to know and safely assume we are on same page. So Shruti is saying clear. Abdul is saying clear. Okay. Others? Okay. I see no queries or questions in the chat box, and few people have confirmed it is clear. So I'm safely assuming. And anyway, I will touch upon this concept tomorrow again to start with. So thanks for listening me patiently today, and see you soon tomorrow. So session is over. Thanks for your time.